Hey everyone, happy Friday. Scott Smith with the Smith team at Keller Williams. Wanted to answer some questions that we keep getting about what is the scoop with rising interest rates and how you can maybe make a more informed decision on your move if that's something that is on your radar either for later this year or even next year. So we put together just some good real estate math and also some insight that will hopefully give you a little bit more information to make an informed decision. So over the last 12 months, the Fed has raised interest rates at least 6 times, and we'll probably raise them again. We'll see what impact that has on the real estate market. But when they're raising interest rates, that is actually the short-term lending rate. So if you've looked at taking out a car loan, if you looked at your interest rate on a credit card, even some of those student loans, or if you have some money in a bank, you're seeing ads all over the place for banks wanting to get good rates on those CDs, some at 5% or more. So that is what the Fed is monkeying with when it comes to that short-term lending rate. It has an indirect impact on the long-term mortgage rates. So certainly not a direct impact, but it does have an indirect impact with that. So we've seen interest rates on mortgages go up probably a few percent over the last 12 months, and it's definitely had an impact on the real estate market. But what kind of impact? We'll definitely show you a few slides with that. So taking a closer look at what the historical mortgage rates have done, we've been up as high as 7.5% in the last 6 to 7 months. But we've also seen interest rates in the mid to low sixes during that same time. So certainly more of a volatile interest rate environment. But what we're counseling our clients on is to date the rate and marry the house that you want for your family. So historically speaking, we've actually seen interest rates, aside from the super low rates that we had over the last few years, we're actually right in the middle of kind of what we see for long-term interest rates. It certainly is frustrating for so many different people that once you're in the real estate market. Supply and demand 101. Home prices continue to rise with the limited inventory. It's certainly stressful for both home buyers and sellers. But what we do with our clients is we actually walk you through some different scenarios and how it might impact you on a long-term basis. So we have a lot of great resources with that. Probably the biggest lesson we want to share with everyone is that every market has opportunity. So if you are, right now, there's a lot of buyers that are actually sitting on the sidelines saying, hey, we're going to wait for interest rates to drop or prices to drop, but they're not taking advantage of some of those opportunities. We're seeing more and more seller concessions. The people that are in the marketplace right now are more serious. We're seeing more sellers open to contingencies, whether it be a home inspection contingency, repair contingencies, even a home for sale contingency. So the speed of the market has definitely slowed down on certain properties. Some of them are still selling in a couple of days. But there is definitely an opportunity within that. So if you're looking to make a move in the next year or so, I'll give you some good insight when it comes to that. So the biggest questions that we get from so many of our clients or just having a conversation with people is should we wait? Should we wait for rates to drop? Should we wait for prices to drop? Should we time the market? And whenever we sit down with a client, we will go through those. We are anticipating that interest rates probably will settle down into the mid to low sixes in the next 12 months. What's going to happen with that? All those people that are waiting on the sidelines are going to jump back into the marketplace, and we're going to see prices accelerate even faster than they are right now. So there's definitely a case to be made for making a move sooner. And we are not seeing prices drop. Zillow actually just posted, this is from a Fortune magazine article, that they're expecting that prices are going to jump 6.5% by this time next year. So pretty crazy to think that the prices are going to continue to escalate. Actually, in the Midwest, we've been more insulated. Different markets, California and their technology regions have certainly had an impact because there's a lot of those businesses that are either working remote and those people are moving to different states. If you go to Texas, Austin, Texas in particular, where Keller Williams is based, their market is absolutely insane. So there are more and more people that are with the remote work environment that are gravitating to different communities, and so that's having a negative impact. But the Midwest has actually been strong and steady. We don't have the peaks and the valleys that other markets might have. So looking at the rising interest rates and how that might impact homeowners, we've heard statistics across the country with the rise in appreciation and the low interest rates. 50% of the people that actually have a mortgage have more than 50% equity in their home, which is a fantastic number. So it's a great sign of a healthy housing market. First-time buyers, do they want to continue renting? No. A lot of the millennials are coming into their peak home buying years, so they don't want to continue to pay those the rental rates that continue to rise. Those rates continue to fluctuate. They're going up and up and up because of the strong demand for that. So you see apartment buildings going up all over the place. Many of those growing families that maybe would be moving this year, they're actually kind of sitting on the sidelines saying, you know what, they moved in 2020, 2021, 2022, where they would have been maybe moving sooner or in today's timing. A lot of the downsizers are staying put. They're not moving, gravitating towards the warmer climates. A lot more people are nervous about some of the weather impact and just the housing shortages. So a lot of them are staying put in their current homes. And if they're kind of at the end of their homeownership journey, where they would maybe going into an assisted living type of situation, if they can have age in place where they might stay at home, they're gonna look at doing that. So we're seeing more and more people that are staying put, which also creates more opportunity for you as a seller potentially to be moving up. So there's an imbalance between housing supply and demand. We had what we call a lost decade of new construction when the economy was way down in 2008 to 2012. A lot of those builders just stopped building. So now they're coming back into it, and it's going to take years and years for them to catch up. So until those builders can catch up and continue to put new homes out there for those growing families, we're not going to see kind of that logjam release for the first-time buyers to get into their new place. So new construction is definitely going strong right now. In the Twin Cities, we're seeing new housing developments continue to grow and go. And many of the builders are actually offering incentives for interest rates too. So if that's something that's on your radar, certainly reach out to us. Just taking a quick glance at the Twin Cities, average sale price in Twin Cities of a $400,000 home. If you sold today and rolled some of that equity into your new home, you'd have a mortgage of about $320,000. So if we looked at a 7% interest rate compared to a 6% interest rate, that same $320,000 mortgage, your monthly payment is only about $210 difference every month. So it certainly can have a big impact on what you can qualify for, but in the grand scheme of things, is it really that much of a difference? To wait for interest rates to go from 7 down to 6%, what's going to happen is we're going to see more people that will be jumping into the real estate market and making a move because they're awaiting. The smart thing to do again is marry the rate, or marry the house and date the rate. So that certainly has an impact with that. Because what we're going to see is those home prices are going to continue to increase, and with that, so should we wait for prices to drop? That $400,000 house today will be $420,000 next year at 5% appreciation. So you're leaving a lot of that appreciation, that equity on the table because you might be waiting for $210 a month with the interest rate drop. So if you divide that $20,000 in increase by the $210 a month you might save, it could take 95 monthly payments or about 8 years to recoup that money. So much better to make that move now. Again, we're going to date the rate and marry the house that you want to be in. So certainly some good food for thought with that. Reach out to us. We can give you some more insight on a one-on-one basis, whether you decide to make a move now or down the road. Most of our clients are looking at making a move 4 to 6 months out. So certainly reach out now if you're planning on making a move in 2024. Be happy to talk to you and just give you some insight on what might be specific to your situation. We've got a great guide that we've put together for our clients that gives you even more insight, more in-depth analysis on what that will look like. So reach out to us and be happy to help you. Thanks and have a great day. Enjoy the weekend, and we'll talk to you next week. Bye now.